everyone, I am Anisha Chitgubi, project organizer at the Young Scholars Initiative Institute for New Economic Thinking. And welcome to the third session of the Stablecoins Uncovered interview series. Today we have with us Professor Garett Jones, a renowned economist and policy thought leader celebrated for his incisive research on money, banking, and innovation in monetary systems. He is professor of economics at George Mason University and chief economist at Bluechip, a stablecoin rating agency. He's the author of the Singapore trilogy, Hive Mind, 10% Less Democracy, and The Culture Transplant. His scholarship is regularly cited by central banks, financial regulators, and tech pioneers. We are thrilled to have you sir, with us, and a very warm welcome, Professor.
Thanks very much for having me. Glad to be here.
So we know that this Genius Act, which is officially the Guiding and Establishing National Innovation for U.S. Stablecoins Act, was signed into law on July 18, 2025. It is celebrated as the landmark legislation that creates the first comprehensive federal framework for regulating payment stablecoins in the United States, aiming to foster innovation and ensuring consumer protection. Now, to take this discussion forward, my first question to you would be, what motivated legislators to sort of prioritize the Genius Act now? Was it already in the back burner and suddenly it sort of like came into the act? And how does this law address the specific gaps or risks in the pre-existing regulatory landscape for stablecoins?
Well, on the first point, I would say that it's important to note that under the Biden administration, the Congress was working on a variety of pieces of legislation that could have created a broad regulatory framework for stablecoins. So the Biden era was an era where Congress itself, Capitol Hill, was doing its own thing, trying to come up with ways to regulate stablecoins in a reasonably prudent way and give some guidance and regulatory certainty to major financial institutions. But that really never went anywhere, partly because they knew the White House wasn't that excited about it, right? And so under the Trump administration, it became clear that the president will sign something on this, right? And fortunately, I can say from my own point of view, fortunately, Congress was allowed to really work its own will on this bill and come up with something that was reasonably prudent. I mean, one can critique it in some ways, but it was a reasonably prudent bill that was made through kind of the normal, some fairly bipartisan, old-fashioned congressional procedures. So when you say why was this going forward? Why was there pressure for this? Partly it's because they saw a lot of they were probably getting real-world attention, real-world interest from major financial institutions, not just the stablecoin agencies, not just the stablecoin firms that we know of, the two big ones being Tether and Circle, but also financial institutions within the normal banking system were really interested in this. My personal view, I'm not a deep insider on customer demand issues here, but my impression is that this is an outgrowth of the Eurodollar market, that basically the same pressures that made people outside the US want access to dollars in the old Eurodollar market, which still exists, made people put pressure on banks saying, hey, are there some way we can get access to stablecoins and use them for international payments? So partly this is B2B, business to business payments, partly this is affluent consumers, partly this is remittance agencies, remittance firms wanting to move money across borders more easily. But there are multiple forms of fairly reasonable market pressures that led to a lot of people knocking on Congress's door to get this bill going.
So I think there were many factors that sort of like worked its way together to sort of like move this bill to become like a law. So the next questions that sort of like come about is like, we know that this bill mandates certain amount of reserve requirements, and it's like 100% backing, which of US dollars or treasuries. Is this intentionally to like strengthen the demand for US debt and bolster the dollar dominance in the cross-border digital finance? Because you talked about the euro-dollar market.
Yeah, I think that's definitely a plus factor from the point of view of Congress and the White House, right? Increasing demand for dollars, increasing demand for treasuries is going to be very popular on Capitol Hill and for every president for the foreseeable future, right? But on the other hand, it's really worth noting that 100% reserve banking is actually a very traditional, ultra-safe form of banking that for a long time, a lot of libertarians pushed. So, my econ department here, George Mason, we have a lot of people who are influenced by libertarian thought and by Milton Friedman's free market-oriented thinking. And at various points in his career, Friedman and the various monetarists back in the 60s, 70s, 80s, they said that narrow banking, banks that were totally backed by either currency in the vaults or by treasuries or by things that are similarly short-term and ultra-safe, was a very safe way to build a banking system. So I think the initial push for stablecoins being these what we can informally call 100% reserve backed forms of bank deposits, that was basically pushed by consumers, right? Consumers said, I'm using something weird and new, this thing called a stable coin. What is it backed by? If you tried to explain that we work like a normal bank, if they tried to work like normal banks just sound crazy if you try to explain them to people, right? I've taught this for decades to students. Like, normal bank balance sheets are really weird, right? The assets on the balance sheet are a bunch of opaque loans, often construction loans or mortgages to people you don't know. And if you tried to start a banking system from scratch that way, it would sound crazy. And so I think there's a good reason why the stablecoin industry naturally gravitated toward being backed by assets that were considered very safe, U.S. Treasuries. My colleague Larry White here, who's an advisor to us at Bluechip, he likes to point out that 100% reserve banking is not quite the same as treasury-backed banking, right? There is a difference, which I often blur, and I just have to. But there is this risk when you're backed by even short-term treasuries, right? If the U.S. government says it's going to default in 90 days, that 100% reserve backing of treasuries isn't quite so good. But that's a state of the world that most people aren't too worried about when they're thinking about stablecoins. And so it's noteworthy that I think stablecoins are 100% reserve backed or treasury backed, very close to 100% treasury backed, because of consumer demand reasons initially. And that made it appealing for the US government to approve these things because they help, yes, as you noted, it boosts demand for the assets that they love issuing.
So, and what would be your take on the second part of the question, the dollar dominance for like the cross-border digital finance and cross-border movement of funds?
So it facilitates dollar dominance, right? The stablecoin industry will continue to facilitate dollar dominance. Nick Carter of Castle Island Ventures has pointed out for a long time that what we're doing with the world of stablecoins is speed running the history of Eurodollars. And when Eurodollars first came around in the 1970s, the U.S. Treasury and U.S. officials weren't really sure that it was good to have fake dollars overseas, right? Fake dollar bank accounts sitting around back then in Europe. But then eventually they realized, oh, this just makes the dollar popular. It helps to make the dollar the financial lingua franca for the world. Sure, there are some weird tail risks, and we hit those tail risks in 2008 when the Fed and the Treasury worked together to create various facilities to help back the Eurodollar market in Europe. But those tail risks seem to basically help make the dollar more popular as like I said, the financial lingua franca of the world. So that's important. It does help. People like to speak a common financial language. And just as the common language of international travel is bad English, the common language of international finance has basically been sort of imitation dollars. And those work pretty well, especially when you look around at the real financial instruments that exist in the world. I mean, when one travels, as maybe you and your audience know, when one travels to especially poor and middle income countries, dollars work pretty well as a form of currency, right? And it's inconvenient, blah, 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 but it's still not as bad as the local money that most people have around the world. So I think this is something that will, it has some limited demand side benefits to the US government, to the US taxpayer. There's a limit to how much, to that. But I think the fact that basically more people around the world, maybe potentially tens, even hundreds of millions of people, basically get to use a second-rate version of the U.S. financial system actually helps spread a form of American cultural convenience around the world.
So that sort of takes us to the third question in sort of like, could this Genius Act framework now trigger like the new wave of global dollarization, particularly like the emerging economies we were talking about, say for countries which have high inflation, you might as well use dollar instead of their local currency. So does this act and sort of create that trend of global dollarization?
Yes, it definitely makes that a lot easier. It's hard to tell how far this goes, right? But you know, when one travels to middle income and poor countries, people like, for instance, to be paid in U.S. currency, but they're really interested in the fact that those US dollars be new and fresh, right? And clean and easy to identify, right? So it's because the new ones are harder to fake. And the stablecoins will give a version of that. Dollar denominated stablecoins will create a version of that for tens of millions of people, probably hundreds of millions of people, to be able to transact on their smartphones using probably apps that are run by major international corporations, major financial systems that have a reasonable degree of trust and trustworthiness built in. So, there are a lot of forms of dollar-like assets being transacted on smartphones around the world right now. And those are usually not backed by anything as credible as, say, Chase or Bank of America or Citi. And those brands, whatever their flaws, are generally more reliable than a lot of the brands that folks are used to dealing with in poor and middle income countries. So I think this retail consumer convenience is something that's really worth thinking about. It's obviously not going to be, it's unlikely to be the largest volume mover in this. I think there'll be big players, B2B payments that'll probably matter a lot more in terms of wholesale movements. But at the retail end, like giving people greater access to convenient, reasonably trustworthy finance is worth a lot, especially when a lot of people are living in countries with 10, 20, 30% inflation a year.
That makes sense. And also the fact that now we have the Genius Act, we know that payment stablecoins are not at the fringe of finance in the world of finance. They're pretty much mainstream now. And many people earlier would be talking about, oh, it's a tunnel for illicit financing. It's a place where people can launder money. Now, do you think that there is a balance that this Genius Act has brought in terms of innovation so that it can prevent this illicit finance, or at least this idea that it uses it for illicit financing or money laundering and other challenges?
Yeah, well, it's obvious that people will use stable coins for illicit purposes. People use smartphones for illicit purposes, and we don't ban smartphones. Instead have a number of regulatory frameworks that help people track down illicit uses of smartphones. Similarly, I'm glad to say that the Genius Act creates a lot of regulatory power to credibly pursue people who are engaged in illicit finance with stables. I don't know the full legislative history here. If I had to guess, it was probably Democratic pressure at push this into the bill, and that's part of the reason the bill passed in a bipartisan way. So yeah, definitely illicit finance, whether it's run-of-the-mill tax evasion or people in a middle-income country not wanting the government to know how much they're worth. Um, some forms of illicit finance, I think a lot of us will broadly agree are really bad, like using stable coins for arms trafficking, very bad. Helping somebody in a middle income country keep their wealth a secret from a government that often steals people's money, maybe not so bad. So there is a balance there where I think a lot of us would say there's some forms of illicit finance that are illicit in the eye of the beholder, and let's make sure that we go after the ones that are most where there's the broadest agreement. Obviously, the U.S. is going to enforce this in its national interest to a very strong degree. Um, I have to say that Tether, the largest stablecoin right now, the most widely used, has been very active in working with the U.S. government to shut down suspicious addresses. Anytime the U.S. government says we think this address is linked to illicit finance, Tether's happy to shut that down. They're unlikely to ever be under the purview of the Genius Act, and yet they work with U.S. officials to shut down addresses to do what they can when asked by governments. I think that kind of trend will continue. There are ways to track. It's worth remembering that stablecoins are not truly anonymous finance. They're not as anonymous as currency. They're more like pseudonymous, right? People are transacting through pseudonyms, and so both detectives working both for the government, financial detectives, electronic detectives, working both for the government and the private sector, have been able to figure out who a lot of these addresses are linked to. And so there's been some success in tracking this stuff down. My guess is this is a place where there will be changes in the law with time to improve the ability to track down illicit finance of varying degrees. The US government will probably get very worried about people using stablecoins as a part of tax evasion, for instance. So that's something where there'll be big bipartisan agreement if there are problems down the road with that. So we can expect further revisions related to tracking down difficulties with this. The U.S. government went through this with the issue of bearer bonds, which were a form of bond where you didn't have to register your name in order to collect the corporate bond coupons. This was something that was more or less eliminated in the 1980s in the U.S. And so we're going to be revisiting a lot of those lessons, not just the black market market for U.S. dollars, where people use $100 bills around the world, paper ones, illicitly, but there's a much that older tradition of bearer bonds, where people could have huge denomination bonds that could be passed from person to person. A plot device in a lot of action films in the 80s and 90s, including Beverly Hills Cop, I should mention, and Die Hard. We're going to be reliving a lot of that, so I think a lot of stablecoin people should be making a point of rewatching Die Hard and Beverly Hills Cop to get used to be ready for the future.
So that comes us to the idea of this technology on which stablecoins run. The rails are blockchain technology. Everything is very transparent. So you know the kind of money that is moving between addresses. And also there is this concept of on-ramping. So you have your KYC, everything already in for on-ramping. And then when you off-ramp it, again, you have that there, the check there as well. So it's only when it is working in the space of blockchain that you could have pseudonyms of people not knowing. But as soon as you off ramp it, that again comes into the
KYC world.
Yes, exactly.
Well, that's definitely true, but it's worth noting that people who aren't even that sophisticated will be able to on-ramp and off-ramp without going through KYC. And let me give a hypothetical example here, which probably has happened a million times already online. Somebody buys Bitcoin completely, de facto anonymously. Someone uses that Bitcoin to buy Tether or USDC on the blockchain, pseudonymously, holds that as a store of value for quite some time. I can have $1 million, so I can take $1 million in Bitcoin, turn it into $1 million in USDC, stablecoin, without doing KYC. And then I can sell that USDC back and turn that back into Bitcoin without using any KYC, without having to say who I am. So a person who uses stablecoins as a store of value for a period of time can do that going in and out without doing KYC if they're using some more anonymous form of crypto like Bitcoin as their on-ramp and off-ramp. So that's a real risk that people will keep track of, and certainly people are keeping track of now. But it's of first order importance, especially if you think of stables as being to the extent that stables end up being a store of value for crooks. They're happy to hold some third-party USDC for 2, 3, 5 years because it's safer than keeping it in a vault in their basement.
And it also earns them returns. So yeah.
Yes.
So moving on to this another part where we know that the Genius Act has a dual path regulatory framework that uses for the people who issue the stable coins in dollar terms in the US and for people who are competing internationally. Now, do you think it creates an unfair advantage for people who are issuing other currency stable coins to work their way in the US market?
This is the problem of all foreign languages, right? I mean, I've been studying French the last couple of years. I really wish that French were more of a lingua franca. French is working at a real competitive disadvantage compared to English, right? So this is, you're right. This is the nature of finance, that there's people love dollars, and some of this was the Europeans. They created some self-imposed trouble when they went with a fairly strict regulatory framework with MiCA. That wasn't that user friendly to firms. So this is a European safetyism, kind of makes it hard to do that rough and tumble competition that's been so much the part of the world of crypto. And I think when they were already working at a disadvantage, when Europe was already working at a disadvantage from not being as popular as the dollar overseas, they really decided to cripple themselves by going with a tighter regulation scheme, probably 50, maybe 50% too tough to actually make people excited about adopting euro-backed stablecoins. And if the euro can't pull it off, I mean, it's going to be tough for other folks, right?
I agree. That's true. So that does sort of like give an amount of disadvantage for people who are like, trying to issue their own local currency stablecoins.
Yeah, this is the usual problem of, somebody who's the second mover in a market, right? There are a lot of markets where the second mover has overtaken the first mover. In economic theory, people get really excited about first mover advantage and lock-in effects, blah 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 blah. But I've lived on the internet long enough to remember when Yahoo was the dominant search engine. Where there's been, Friendster, my God. Um, so. And so when second movers have an advantage, that's generally because there's something kind of weird about it that makes it very appealing. And lighter touch regulation could have been one version of that for the euro, right? In the world of finance, you can't innovate in as crazy ways as you can with, say, social media platforms. But you've got to find what your advantage is going to be if you're going to be a second mover who's trying to take over. We're trying to at least get a decent market share.
True. So now that the US has had like a first mover advantage in bringing in like a stable coin specific regulatory roadmap to the world, do you think there are other countries will be motivated to look at this and sort of like take it back to their countries and put this in place?
I wish the world worked that way, but I think a lot of it is people will look and say, well, that's already taken, so what are we going to do now? So the best they can do is try to provide, I can imagine countries like, large economies that could have had some first mover advantage, someplace like Brazil, right? Someplace like Argentina, big enough economies, Nigeria. These are places that could have had a shot because they had big enough internal markets to build up a local mass and then spread it overseas. These are countries that have, especially I think of Brazil in this context, as having a lot of experience dealing with middle income countries. So apparently a lot of sort of internet backbone and cell phone networks, for instance, in poor countries, is installed by Brazil. Why? Because Brazil's figured out how to do it in Brazil, so they can do it in other countries that have, similarly difficult terrains, middle income, a fair degree of local corruption. How do you handle all that? This is something where middle income countries could have had a first mover advantage, and if they don't, it's going to be tough. China gets some attention, right? People think that perhaps their electronic form of the yuan might work well, but people will be very afraid of using a form of currency that is can be less trusted. One thing about the U.S. system is that the U.S. has often just sort of let people do things sometimes and run things without worrying to an incredible amount about the short run political and economic benefits that may be changing with this administration. But that benefit means that one doesn't have to worry every day. If I send money to the wrong person, will the government shut this account down, right? So China's going to have a tough time getting regional adoption beyond people who are deeply connected to the Chinese economy. Whereas US dollars, people figure, well, the US government is just going to let this stuff run. There's a sort of, one needs to be able to take a financial system for granted to be able to really run with it.
It has to be boring. It has to be mundane. It has to work everywhere.
And you have to think that these guys aren't going to rethink things every 20 minutes just based on one or two bad headlines. So
True.
that's tough.
And that's what they say about politics as well, and the government, that they have to be boring governments. If the government is too headline creating, then it creates a lot of
uncertainty, and then you're worried about, yeah, if I make a deal today, is this deal going to stick next week?
Absolutely.
Is it one tweet away from the whole thing coming undone? That's tough. I mean, it's real, right? When it's that kind of money being involved, right? Yeah.
So now we come towards the end of this discussion, where I'm going to ask you about the main criticisms or limitations that you see in the Genius Act that perhaps you have discussed with people in the crypto industry, international community, the academics community. And do you think there are places where this act may be amended? Maybe it's too early because we actually haven't seen it work its way through. But even then, if you've gone through it and through the discussions, do you think there are areas to improve?
Yeah, I think one is that the audit requirements are pretty weak. So one thing that at Bluechip, my colleagues and I have done in comparing the Genius Act to our own rating system, we've asked ourselves like, at Bluechip we rate stablecoins and we give them A plus through F ratings in terms of safety. We rate them on safety. We haven't given an A plus, but we've given a lot of Fs. And the coins that we've given A's to are disproportionately likely to be ones that were uh, authorized under the New York State Department of Financial Services, NYDFS. And the NYDFS guidelines are quite strict and reasonable. They're this nice balance of reasonable and strict. So a number of large stablecoins, medium-sized stablecoins have managed to get their approval. PayPal USD is maybe the most famous of those. Uh, and one thing that the Genius Act does not require that we thought was a bit lax was that it does not require audits of the assets of a stablecoin unless that stablecoin project is over $50 billion in value. So 50 billion is a really big number. Now, these stablecoin projects are still banned by law from doing a lot of bad things, but there's a difference between saying you're banned from doing a lot of bad things with your money versus we're going to come in and check to make sure you're not doing bad things with the money. Having some accountants from a big four accounting firm come in and check your books once a year or once every 3 months is a really good way to make sure that somebody is actually holding the treasuries every day and not just once or twice a year, for instance, right? So um, audits of stablecoins, audits of their assets to make sure in particular that they're holding the assets they say they're holding and that they're not rehypothecating them, that they're not using them as collateral for some other fancy financial transaction. That's really important for regular end users. I want to make sure that if you say you're holding 90-day treasuries, you're holding 90-day treasuries, and you haven't let those out as collateral so you can buy a bunch of Bitcoin or so you can buy a bunch of Microsoft stock or whatever it is you're interested in. That's something that anybody has to worry about. Every time there's a big pile of money, people are tempted to abuse that pile of money. And going beyond mere promises to audits would be one way to improve the Genius Act. I suspect that $50 billion audit cutoff would be a reasonable target for bringing that number down quite a bit.
Yeah, because earlier you were mentioning that the fact that it has 100% treasury backed was consumer driven. So perhaps you will find more companies trying to get third party auditing done because that shows that they're fair and they're safe. And it would be again be consumer driven in some
That's
sense.
reasonable to think that actually customers will insist on audits as a sort of safety mechanism, a sort of good housekeeping seal of approval. Like, I mean, that's part of what we do at Bluechip. That's what Standard & Poor's has been doing with their form of a rating system for stablecoins. Private sector ratings have been useful in the past, and we're good at basically rattling the cage and getting people to improve up their standards.
And that brings me to my final question. How do you foresee the Genius Act influencing the power dynamics between private, public institutions, central banks, private stablecoin issuers, tech giants, international bodies for like the fight or contest for like reserve currency innovation?
That's a great question. I mean, certainly the Fed will have to keep an eye on, and all the regulators, anybody involved in regulation, financial regulation will have to keep an eye on the stablecoin world because this could potentially be the euro dollar market times 5, times 10, moving into countries that are poorer than where the euro dollar market traditionally existed. And so the US, both the more independent agencies like the Fed or maybe the SEC, and the more political agencies like the Treasury or even the White House, these folks have to decide if there's a euro dollar, if there's a stablecoin meltdown in Indonesia, if there's a stablecoin meltdown in Nigeria, is that a systemic risk to the US, right? And so this is not something they've had to evaluate in the past to a material degree. So they'll need new early warning systems, new monitors to keep track of potential systemic risks going on in these places. And they may even start having to worry about ones that aren't Genius Act backed, right? So, Tether probably won't get approved probably won't go through the process of getting Genius Act compliant, but they're plausibly systemically important to the global economy, right? Especially to the reputation of the dollar. So, can you see a scenario where the U.S. Treasury ends up creating sort of lines of credit to, if not Tether, then one of Tether's partners, which, as you may know, is Cantor Fitzgerald. So, which is where Howard Lutnick was CEO. So there are ways you can imagine where stablecoins become systemically important, and so central bankers, regulators will be keeping an eye on these for a long time.
And you think that there would be a contagion, for example, if there is some problems that are there in stablecoins, because we know that the markets where stablecoin function and where the treasuries function are not absolutely aligned. There are times when this market of stablecoins is 24 bar 7, 365 days, whereas the treasuries don't work as on all hours, all days. So do you think that kind of mismatch could also be one of the reasons why we would find some problems in future?
You're exactly right about that. That U.S. regulators generally do not, they don't keep somebody at the desk all night, right? So they are not like firefighters. And we don't have somebody who's just sitting there waiting for something to go wrong. And the magic of stable coins is that they're a form of, as many people point out, these are markets that can clear 24/7. They can be making payments on weekends. They can be earning interest on weekends and solving problems all the time. But that means when there's a hiccup, that means you need somebody sitting at the desk at the Treasury or at the Fed or the SEC who's able to sort of respond quickly. And that probably means something. If the financial markets really are going to work 24/7, that means we need financial firefighters there 24/7.
Perhaps that could be another factor that could be included in the Genius Act.
Yes, exactly. Staffing up a night desk for the Federal Reserve and for the Treasury. And that may mean literally, I mean, you could have people doing night desks in DC, but it's probably much better to actually have people in different time zones doing this, right? So
True.
you want to have a serious sized branch of a Fed staff and Treasury staff sitting there in Hong Kong, or better, Singapore probably nowadays, and other places, basically staff so that there are people awake with authority to act on behalf of the U.S. government in the event of payment systems issues.
True. And just another question before I move on to the fun side. Would we see, because Bluechip is a stablecoin rating agency, do you think there will be more agencies like that coming up for the stablecoin space? Because we already have that for the bond space, like S&P, Moody's. Do you think that same would happen for stablecoin market as well?
Yeah, it seems very likely to me. I'm surprised though that Bluechip has been around for a couple of years now, and Standard and Poor's is the only other agency that came out and created something like a rating system. Moody's has something private that they haven't released publicly that works a little bit like that. Um, but it does seem natural that people will want something like ratings to tell them something, to give them measures of safety. Um, the U.S. The Genius Act is basically a thumbs up, thumbs down system. So it's probably too blunt for a lot of private sector actors to rely upon. And that thumbs up, the system is a little lax by our standards at Bluechip. Not terrible. I don't want to say it's good. It's a huge step in the right direction, but it's too blunt and probably a little too lax. And so you're right. There's room for more private sector raters to pull this off. The question is, what business models will they find that work for them? That's always a tough one. When your goal is giving out public goods, it turns out that a lot of people like to free ride on public goods. This is something no surprise to any economist. But I'm sure there are a lot of folks sitting out there trying to figure out how to do this. And with luck, there'll be good Wall Street desks, just people who work in the bond markets who will just create something akin to a blue chip rating system just on their own. I've said for a long time that if one were going to create an alternative to our blue chip rating system, which is very methodical and menu driven and really algorithmic, the alternative to that would be useful would be a seat of the pants version of this, right? A lot of people who pick stocks or who rate bonds just go based on sort of a mixture of facts and vibes. We decided at Blue Chip we are not doing vibes, we're doing facts. But obviously vibes in real life are very useful and have predictive power in the markets. And that's probably one way where I think an innovator could make some progress, is going with a rating system that use the sort of soft knowledge that's hard to write down, that professional business judgment. I think that can be used to evaluate stablecoins in a way that we've chosen not to do at Bluechip.
I think in the future, I think in a couple of years, that instinct or the feeling of the vibes of the market may be more dominating how people look at stable coins and rate them.
Yes,
It may
yes.
be just too early for now for people to like understand, and we may see that going forward. So this brings us to the end of the serious discussion on stablecoins. I'm going to put forth 5 rapid-fire fun questions for you. You don't have to think; you just have to answer at the
Okay,
go. Okay.
great.
The first one being, what's the most underrated economic insight for understanding crypto and DeFi?
Oh, that for underrated for understanding crypto and DeFi. I would say in terms of stable coins, which I understand best, is that bankruptcy remoteness is really important. You really need to know if your stablecoin goes down, are are you the stablecoin customer first in line, second in line, or 10th in line? And this is something that people don't think about much until things go bad. I thought about this during the 2008 financial crisis in a different context, and it has turned out to be very important in our ratings of Bluechip. That some really like Circle, for instance, is not bankruptcy remote at the moment to our satisfaction. They claim they are, but to our satisfaction, to Bluechip, their assets are not bankruptcy remote. But the Genius Act will make them bankruptcy remote. So I think yeah, you want to know whether your assets. There's a romance about the blockchain that the blockchain can solve all security problems and all trust problems, trustworthiness problems. The blockchain is very powerful. Um, the blockchain, if it has to stand up to a US bankruptcy judge, will lose. So run-of-the-mill law is still mundanely important in the world of crypto, especially in the world of stables.
That was wonderful. I think many people haven't thought about the degree of which those bankruptcy points will affect a person, the consumer. So that was interesting.
It's easy for a bankruptcy judge to just say, you haven't paid your workers for 6 months. They're getting their money first before the stablecoin holders do.
Definitely.
It would be a great headline in the Wall Street Journal. No bankruptcy judge gets in trouble with that, and only an ironclad law can fix that. Yeah.
True. The next one. If you could, with a snap of your fingers, fix one major regulatory hurdle for crypto innovation in the US, what would it be?
Oh, I would say to make for cryptocurrency regulation in the U.S.
Yes.
Yeah, just making clearer that there's a right to try for large financial institutions. Creating legal safe harbors for people to create small and medium-sized sandboxes, where as long as this thing is below, $20 million or $200 million, and as long as you're using sophisticated customers involved, like you can just do whatever you want. So safe harbors have been very important in U.S. law and I'm sure around the world. So that because large organizations are very risk averse when it comes to innovation, and reasonably so because they can get hit years later by lawsuits. So a version of the right to try when it comes to financial innovation in crypto by large systemic actors would be really valuable.
Ah, nice. Okay, so this is by the Singapore Trilogy books. If a person had to pick one of these books to read and understand more about the entire Web3 verse, which book would you recommend the person to read first?
Oh, it's got to be 10% less democracy because there I'm saying that basically insider elites are actually underrated. As much as people want to complain about central banks being terrible at stuff, central banks that are more independent from government do a better job than those that are more politicized, more democratic, I would say. And that like this sort of elite control uh, induces long time horizons that are good for economic innovation. I think 10% less democracy is the one there. Yeah.
Okay. And which stablecoin or digital asset ecosystem do you think has the strongest fundamentals, and one crypto hype that you think is just overblown?
Oh, and I mean, you've got to say that PayPal USD has just really good fundamentals, right? Because they're on everybody's phone already.
Mhm.
That's what they have, right? And people know that PayPal works. So they're not huge right now, right? But that's a really great strength. You also have to, in the same breath, you also have to say anything anything that Stripe is affiliated with in the stablecoin space is really has to be underrated. No matter how well it's rated, it still has to be underrated. because the Collisons have created a culture of innovation and care. Um, like move fast and keep things safe has been basically the way their system has worked well for a long time. And so I'm very much uh, optimistic about them coming up with new things that work. In terms of overhyped, I mean, it may be that Circle is overhyped, but only because it's already high. It's going to be a really important player for a long time, but it seems as though they've decided we just want to play by the rules and make everybody happy. And that's really great. And that's a version of what you said before, which is that boring is what you want in finance. And so the fact that Circle is going with boring might mean that we expect less crazy, interesting, you know, app-based innovation. But at the same time, I think I have $13 worth of USDC sitting in an account somewhere. And the fact that I don't actually know how much it is a sign that it's safe enough for me to not worry about.
Okay. And the last one, if you could have dinner with one figure from like the cryptoverse or a Web3 visionary innovator, who would you pick and why?
Okay. This is an easy one. It really would be the Collisons because they talk about cool books. So the fact that they both read a lot and are interested in good books. Like I know that already enough about them. Their interest in literature and art, and so it's basically for non-crypto reasons. Like we would talk about some stuff about stables and finance, and I'd find that really interesting. But the fact that we could so easily move into the sort of liberal art side of things, and I know that would be a comfortable and fun part of the dinner, is part of the reason I do it. I think it's me being, I was a history major, right? And so I always loved the liberal arts as sort of my intellectual home. And to me, economics is just part of the liberal arts. And the Collisons, I think, get that about human knowledge.
All right, Professor, this brings to the end of our interview series. Thank you so much for accepting our invitation and answering all our questions and being so magnanimous with your time.
Glad to be here. Thanks to do it. Glad to do it.
Thank you, Professor. Take care.
Take care.